So as of now, the market is still under pressure. The Nifty is down over 200 points and there's no real recovery in store. As we were telling you, the next line of support for the market, at least the important level to watch, is the 200-day moving average, which stands at 16,980. That's still a distance away, but it looks like the texture of the market has weakened quite a bit. You can see that in the advanced decline ratio, which is now has over 2,000 stocks on the declining side. Because of business updates, there are many stocks which are under pressure. Bandhan Bank, in fact, is now down almost 3% on the back of its business update. Tata Motors is down about 4%, 3.5% on the back of weakness in JLR sales. But the rupee has opened at a fresh low of 82.62. Lata is here with a quick update on that. Lata.
Well, the latest from the FX market is a huge recovery actually in the currency. Yes, the rupee has every reason to weaken because it's a triple whammy. It's higher crude prices, it's a stronger dollar, and it is higher US yields compared to what it was when we went to bed on Friday. So the New York markets were indicating 82.82 actually in Friday close. That was expected to be having an impact in the opening trades. But from the word go, the Reserve Bank has been there and it has followed up. The appearance seems to be, and this is just chat, that, our rupee came under severe pressure in what you call the NDF market, the non-deliverable forwards. That is the rupee being traded in foreign destinations, in Dubai, in New York. And that was, more sentimental. The NDF had ran up huge positions against the rupee, that is long dollar versus the rupee, because it was seen that FX reserves fell. If you remember, the Friday figure showed 532. Our high was 640 billion. And then crude was also inched its way all the way to 97, striking distance of the triple figure mark. So it looked like, the RBI, the rupee was getting singled out, or at least that is what readers are, viewers are reading from the RBI's rather staunch support for the currency at this point in time. Left to itself, the dealers are of the view that the rupee would have gone to 83, or at least towards, 82.90, thereabouts. But it has been a very spirited defense, probably because the Reserve Bank feels that sentiment and speculation is taking the rupee more than what is warranted. We'll have to wait and see when Europe opens, because today no US, Columbus Day, and no Japan either. Those are the liquid markets which give you an indication of DXY and US yields. So we have to wait for Europe to open. The bond markets are also under pressure, but less so. That's because we had a very good auction. Friday auction was better in terms of buying than what the market anticipated. So yes, yields are at 748 compared to 745. But, on Friday, they even saw a high of 7.51. Compared to that, it's better.
All right, Lata, thank you very much. So maybe slowing down the pace of depreciation, as Lata pointed out, on the currency at least. So 82.37 is flat. Some really, as Lata said, spirited defense are coming in early this morning. All right, let's get back to corporate talk. We have the IT earnings season, which is due to kick off today, and all eyes are on the workforce, right? Workforce dynamics. So far, the dynamic was in favor of employees. Multiple job offers on hand, and jobs were for the taking, for the choosing. Has that balance shifted a little bit? There are reports that companies are actually now slowing down the pace of hiring. We've heard that from more than one company. We have Hitesh Oberoi joining us, Managing Director and CEO at InfoEdge, who, of course, has a large recruitment business. Hitesh, great to have you with us here. Thank you very much for your time on CNBC-TV18. Prashant this side. So tell us, has the balance shifted in favor of companies? Has supply kind of overwhelmed demand because things have, on the demand side, maybe deteriorated a little bit? And second, how much are recruitment revenues as a percentage of your total business? Hitesh, go on.
Yeah, both the demand and attrition were off the charts for the last 7 quarters for most companies. That's, as you know, that's really good for our business. Of course, it's very hard because we're also trying to run an operation, but on the business side, Naukri was growing like a startup for a while now. Things are beginning to settle down a bit, but it's still very, very hard to hire good people. It's not easy to hire good people. People are becoming choosy. The startup scene has slowed down a little bit. But there are still a lot of opportunities out there in the market for the right people with the right skills. Every company wants to go digital. So, tech talent, digital talent continues to be in demand. Over the last 6 months, we also saw the offline economy open up once again. I mean, a lot of these companies, retailers, hospitality companies, travel companies, hotels, they had laid off people during COVID, but they're now sort of bouncing back and they're hiring in large numbers once again. So we are still not complaining, but yes, things are beginning to settle down. The market is not as hot as it was, maybe 2 quarters back.
So, Hitesh, tech hiring is what percentage of your recruitment business traditionally? And could you give us some sense of over the last 7 quarters, what was the pace of growth there? And what is it likely to be now from here?
So tech stroke digital hiring is almost 50% of our revenue. And the share of tech hiring in our total revenue has increased over the last few years. It used to be 40-45% earlier. It's now over 50%. So Bangalore, Chennai, Hyderabad, these are primarily tech hiring markets. Pune to some extent, parts of Gurgaon and Noida as well. The share of these sort of geographies and this segment in our overall sort of business has increased over the last 8 quarters because the pace of digitization has increased globally, right? But like I said, it's tech talent is global, tech demand is global, and it's still not easy to hire tech people. There was a huge demand-supply mismatch for the last 8 quarters. It takes 4 years to churn out an engineer. So this demand-supply mismatch.
We get that. I mean, you said to find that right person, it's always hard, right? And maybe it's harder still now. But if you can give us some sense of what were growth rates looking like last many quarters, and what would it be now? Some idea.
So, last year, our India sort of hiring business grew by over 60%. In the first quarter of this year, we saw an acceleration. In fact, it grew by 80%, the domestic B2B India recruitment business. The second quarter, we haven't announced the results as yet, but there is a slowdown compared to the previous quarter, but we are still not complaining. It's still pretty solid.
It's interesting, right? I mean, hard to find people, not easy to hire. And then you have these concepts like, of course, we had the Great Resignation last year. Then you have quiet quitting.
Yeah.
I don't know whether it's a Gen Z, a younger generation thing where people are just, there's so much trauma after the pandemic. I mean, it's real. It can't be quantified, but it's showing up in the workforce as well. Hitesh, just wanted to ask you about, I mean, since this is, of course, a show which is more tuned towards what shareholders want, for your own business, right, your recruitment revenues was up 45% in FY22. So give us some numbers. Will FY23 be slower? Because that's something that another player like Teamly has also told us. What would the average growth look like for you?
See, FY23 Q1 was actually better than, Q4 of last year. So till Q1, things were very, very rosy. And like I said, Q2 has slowed down a bit, but we're still not complaining. It's unclear how Q3 and Q4 will pan out. A lot will depend on what happens in the rest of the world. The IT market is not just indexed to the local economy, it's indexed to the global economy. It's even more indexed to the US economy than the rest of the world. So a lot will depend on what happens in the US. In the past, we have seen that India actually is the solution. Whenever there's a recession in the US, for a while you see a lull in hiring, but over time, more and more work is offshore to India. So if that happens this time around also, we may see a slight dip for a quarter or two, but in the long term, it may be good for Indian companies because more and more work will be outsourced to India because US companies will want to cut cost. So fingers crossed on what will happen going forward. Q1 was fantastic. It was even better than last year. Q2, we are not complaining.
I wanted to understand in other spaces like real estate, you have been making some investments. So what is your interest over there and what could the future look like for InfoEdge?
Well, actually, the real estate market has turned around after a long time. It was in the doldrums. It was actually in the dumps, if you ask me, for the last 7-8 years for a variety of reasons. For the first time, after a long time, we are seeing prices go up in segments. We are seeing the rental market look up. Commercial real estate is coming back because companies are getting back to work. They're getting back to working from office. The demand-supply mismatch has corrected because not much construction activity took place during COVID. And as a result, the amount of unsold inventory in the market has gone down. and in pockets there is no inventory. So after a long time, the market has tilted. It used to be a buyer's market earlier. It is no longer just a buyer's market. It's delicately balanced. Of course, one doesn't want prices to go up too much, because if real estate becomes unaffordable, a lot of people will leave the market. So we are in a good space, I would say, in the real estate sort of space. Fingers crossed on what will happen going forward.
Hitesh, talk to us a little bit about the capital allocation, because you're putting money into, I think, AIFs, etc. as well, right? And yeah, so just a little bit on, and of course, you're putting in money in investee companies, adjacencies, 4B, etc. What's the thought process really, and what should we expect here?
No, you're absolutely right. See, the Naukri business is churning out a lot of cash. The Naukri business generated 1,000 crore of cash just last year, right? Of course, we lost money in some of the other verticals we are in, but the recruitment business is very, very profitable right now and growing rapidly as well. And we are aggressively investing in behind multiple initiatives. So inside the company, we have seeded a bunch of startups. We have a blue-collar platform, Job Hai, which we are now taking to other cities. We piloted it in Delhi. We're investing aggressively behind our real estate vertical, behind our matrimony business. We acquired a dating site, Aisle, some time back. We've invested in, like you mentioned, adjacent areas. We've invested in Broker Network, which is a real estate sort of venture where they're trying to do things very differently and discover new business models as we speak. We have ventured into the study abroad market in our education business. We just upped our stake in Coding Ninja from 25% to 51%. The long-term plan is to sort of integrate deeply with Coding Ninja and transform Naukri from not just a job site, but into a career platform, which helps people find jobs and prepare for their job search, also not just find jobs. So there's a bunch of action. I mean, we have built a very high-quality data science and AI and machine learning team over the last few years, and they're working on a lot of good initiatives, which is helping us improve our core platform experience. So there's a lot of action, a lot of things we're investing behind. We acquired a few startups also, as you know, over the last few years: iimjobs, Hirist, Zwayam, DoSelect. We continue to invest aggressively. We have a financial investing plan. We have set up a couple of AIFs. These AIFs continue to invest behind new startups. We also continue to do follow-on investments in existing startups. So a lot of action at Info Edge. We're investing in a lot of areas. Hopefully, some of these will yield good returns over a period of time.
And investing in these entities, startups via AIFs would be, instead of investing directly, the logic would be, these are for a certain number of years, lock in, so more discipline in that sense.
AIF is set up like a fund. Earlier, we used to invest. See, all the strategic investments, all the M&A, etc., is from our balance sheet. But all financial investing going forward is going to be through the AIF. Earlier, that was not the case. We had invested in Zomato and Policy Bazaar from our balance sheet. But now we have set up a fund structure. We have, and of course, the fund has a life, but it's a long life fund. It's 12 plus 2. And these are, the AIF is going to be basically investing behind, it's going to be making financial investments as opposed to strategic investments.
Okay, so will you be investing more in names like Coding Ninja? I mean, you spoke about that briefly. I think you made a 150 crore investment there or thereabouts. Any more that you're looking at?
So we've been partnering with Coding Ninja for a while. We started with a 25% stake. We've upped our stake to 51%. The idea, like I said, is to deeply integrate with their offerings and take them to more users on the Naukri platform over time. Like I said, we want to transform Naukri into a careers portal where we actually help people prepare for interviews, help them understand which skills are in demand, train them in these areas. And if this starts to work with Coding Ninja, of course, you would want to invest more and more over time.
All right, we'll leave it at that. Thanks a lot, Hitesh. All the best. That's the word coming in from Info Edge about the several businesses. They say that hiring, it's very hard to find good people. Hiring has slowed down a bit, and I guess that's showing up in their stock price as well. Info Edge has been under pressure for a while. But Lemon Tree can't say the same about that. Hiring may have slowed down, but people are definitely taking more holidays. The stock is at a record high. The company has been in the news on account of adding several properties to their portfolio. The management earlier said they are looking to operationalize 1,000 rooms and 15 to 20 hotels this year. To understand what occupancy is looking like in the midst of the festive season and the outlook for the rest of the year, Patanjali Keswani, the chairman and managing director at Lemon Tree Hotels, joins us now. Mr. Keswani, good morning. And I think things are getting better and better every time we speak, especially for the hotel industry. But wanted to ask you, some numbers. How has the occupancy been in this quarter so far? And what is the expectation over the next few quarters?
Morning, Sonia. So, the hotel business is fairly simple from an occupancy and average rate perspective. So, Q1 and Q2 are generally somewhat similar. They account for normally about 40 to 45% of the annual income. So, Q2 would be very similar to Q1, more or less the same, in fact. But Q3 and Q4 would be, like normally it's a 10 to 15% price hike and a 10 to 15% occupancy hike. So if you add the two, it's a very simple number. It will be 1.2 to 1.4 times. H2 will be 1.2 to 1.4 times the H1 income, with the expenses remaining the same. So which is why you really get most of your profit in H2.
Okay. So what I'm just trying to understand, what is the outlook for the second half of the year? Because in terms of number of keys, how much did you add? You said you would operationalize 1,000 rooms this year and 15 to 20 hotels this year. But how many have you added in this quarter up until now? And what is the outlook for the second half? Oops, okay, I think we've lost that feed with Mr. Keswani of Lemon Tree Hotels. But it has been a spectacular showing. The stock is at a record high. The stock has doubled this year. People are definitely taking more holidays. And you can see it all around, right? I mean, just call up one hotel and they're sold out, I think, for the next, 5-6 months.
Oh, absolutely. They are needed. So I think we've got the management back, Sonia.
Yes. Mr. Keswani, I was asking you about the number of keys that you've added in Q2, because earlier you had said that you're going to operationalize 1,000 rooms this year and about 15 to 20 hotels this year. What are the numbers so far, and what's the outlook for the second half?
So we opened, I think, 4 hotels in the last 60 days. The outlook is looking very good, actually. We have roughly 1 or 2 inquiries every day to take over the management of a hotel. The point for us is basically that our conversion rate is not that high because there is very often an issue about brand coherence. So if it doesn't really meet our brand standards and the investment is very high, sometimes we don't proceed with the deal. But that 1,000 rooms was the minimum number I gave. I suspect it will be much higher than that. As far as the future goes, we will cross 11,000 rooms by the end of next year, which is where we want it to be. And in 4 years, we should cross 20,000 rooms, maybe 21, 22,000.
Okay.
Right. Mr. Keswani, the big one which is coming up in Mumbai, but that's only by the end of next year, right? Aurika, almost 700 rooms. I mean, how is that proceeding? I mean, how's work going on, and are you on track? Mumbai has always been through slowdowns, ups and downs, one of the strongest occupancy and room rent markets, right?
Correct.
What will that do? How much will be this property as a percentage of your overall business, revenues, for example?
See, Aurika, we already have a 300-room hotel in Bombay, which is doing very well, and it's fairly close to the Aurika. That's a Lemon Tree Premier. My expectation is, just on an absolute number, the Aurika Bombay will do about 300 to 350 crores revenue, and it will have a net operating profit of at least 175 crores, probably 200 crores. So that hotel will do north of 12,000 rupees average rate. In fact, our Lemon Tree Premier is doing north of 7,000 now, and I expect it will do 80 to 90%. See, New York and Bombay is very similar to New York. Both are recession-resilient markets. Every year there is a steady increase in demand because of the fact that they're both commercial capitals. And if I look at India, the most de-risked market is Bombay in every way. And, I was listening to you folks talk about, festive demand and hotels are sold out. That is really only hotels in leisure markets. Business hotels, and 85% of our inventory is business hotels, those traditionally do badly when it is Dussehra and Diwali. Because very few people travel for business reasons. You know, everybody, I'm sure you folks too, me certainly, we take time off during this period. So October will be low demand for business hotels, very high demand for leisure hotels. But in November, it will be exactly the opposite. The demand for business hotels will be insane. And that's why, you know, when I say that we'll do 10, 15% better in rooms and in revenue independently, both of them, what I'm really trying to say is that in November, you will do typically 1.5 to 2 times your October revenue. But the average for the second half will be a 25 to 35% hike in revenue.
All right, got that. Well, all the best. Thanks a lot for joining us and speaking to CNBC-TV18. That's the word coming in on the hotel industry. It is more personal travel that's picking up now, and they're awaiting a pickup in corporate travel. But there's some unfortunate news coming in this morning. Mulayam Singh Yadav, who's a senior Indian politician and founder of the Samajwadi Party, has passed away after a prolonged illness at the age of 82. He was undergoing treatment at the Medanta Hospital in Gurugram, and his health had been quite critical for the past few weeks. In addition to his role as the Supremo of the Samajwadi Party, he was 3-time Uttar Pradesh Chief Minister. He was a member of the Lok Sabha as well, representing the Azamgarh constituency of Uttar Pradesh.
Welcome back. We've just crossed the 45-minute mark in terms of trading for the day. And so far, you know, it's still down 200 points, 230, roundabout where we started. Mitesh Thakkar is with us. Mitesh, you know, if you do get that bounce at some point during the course of the day, what should one do? How should one treat that? To use that to sell or even buy now in anticipation of the bounce to sell later? What's the strategy?
Yeah, morning again, Prashant. I think the initial feeling is that with the gap down, the hourly charts have turned negative. So I think bounces I would want to not sell aggressively purely because there's a 200 average coming up at the lower levels, but I would want to buy into put options for the October expiry. So let's say if we get closer to about 150, 160 zones, then I think, you know, buy into 17,200 or 17,100 strike put options for the month of October, and you can keep a stop at about 17,250 on this spot. So about 90 points stop in the spot levels would translate to about 45-50 points on the put options which you're buying. Having said that, I have one sell and one buy call right now on the stock side. HUL is breaking down, so that's a sell with a stop at about 25. Give me a minute. Yeah, 25.70 for targets around 2,500, and the other one is a long on Glenmark with a stop at about 383 for targets of around 408, and disclaimer that we have some call option positions in Glenmark.
Okay, all right. Thanks a lot for that, Mitesh. Have a good one. Let's shift focus now to the commodity markets. Manisha is joining in. Manisha, what's the one commodity that you're looking at this morning?
Morning, Sonia. I'm looking at the zinc prices. We fell nearly 4% on Friday, but when you look at the fundamentals, those clearly are positive. But the kind of sell-off that we've seen in various asset classes, including commodities, has been majorly macro. So what we are reacting to right now is the Chinese services numbers that has come in weaker than what the street was expecting. You have the US non-farm payroll data where the markets are reacting to, and the strength in US dollar also continues to weigh onto the market. This week, it is going to be the US inflation numbers, China inflation, and trade data that we will wait for. In the meanwhile, when you look at the individual fundamentals, well, the LME now has announced limiting Russian zinc availability on its exchange in sense of warehousing and trading on the exchange as well. And you have a third zinc smelter now looking at a shutdown in the western of Europe. This one really comes in from Glencore yet again. This is going to be the second Glencore plant that we are looking at in sense of shutdown. So the markets should be taking premium because of that. And that is happening actually in the spot markets there. So when you look at the Glencore, which is going to curtail production at the Nottingham plant in Germany, markets are looking at strong support on the physical markets because of that there. If you look at this plant, this produces 165,000 tons per annum of refined zinc. So there is some more zinc that is going off the market in the physical markets there. Overall as well, when you look at other plants in the international markets, Glencore's Porto Esme smelter in Italy has seen some shutdowns. You also have seen Nyerstar plant shut down in Netherlands as well. So when you look at the overall numbers into the market, we are looking at a bigger chunk of Europe production going out, which is 399,000 tons. And out of Europe, which is majorly China and US, nearly 240,000 tons also seems to be going out. Inventories have continued to decline as well. When you look at the overall refined output, in the first 7 months of this year, that is down by nearly 2.5%, 2.4% as well. That is the view coming in from International Lead and Zinc report there. The unwrought zinc exports have continued to decline, especially from Russia. 2017 was 40,000. Last year was just about 622 there. Overall inventories have continued to decline. When you look at the LME numbers, we are trading at a multi-year lows in sense of inventories. And the zinc inventories also are trading at the lowest level of 2021. When you look at the prices itself, it is a big range that zinc clearly has seen until now. We did see 16-year highs in the month of April at around 4,498. Currently just about holding $3,000 per ton there. And that's exactly the forecast that we have seen coming from various banks and brokerages as well. If you look at Macquarie, they're looking at 3,600 this year, and then even lower zinc prices next year. And the lower zinc prices is what Citi also seems to be predicting for next year. So yes, much lower prices expected.
All right, Manisha, thank you very much for that. Now, the second quarter earnings season gets underway today with IT giant TCS set to report its second quarter numbers. Rima is here to give us a quick preview. Rima.
Thanks so much for that. So revenue growth is expected to be steady for TCS this time. So constant currency revenue growth of about 3.4%, similar to Q1, though in dollar revenue growth will look a lot lower at 1.3%, and that's on account of cross-currency headwinds. For TCS, there will be margin expansion. We typically see margin expansion in Q2 because it comes off a low base in Q1, which were depressed on account of wage hikes. So margins, according to our poll, at 23.8%, an expansion of 70 basis points. And this margin expansion, coupled with the top-line growth, will drive about an 8% growth in the company's profitability. Well, TCS does not give you an annual guidance on revenues as well as margins. So what's going to be key? Key is going to be commentary. And in that, this time at least, the management did tell us that Q4 margins, Q4 FY23 margins will expand to 25%. This compares with 23.1% in Q1. So the management did indicate that Q1 margins were depressed. They will expand. So does the company hold on to that margin guidance? In terms of demand, watch for commentary surrounding UK as well as Europe, because TCS roughly gets close to about 30% of its revenues from these two geographies where we know the demand is slowing down, the economy is under pressure. Is that something which is going to start to hurt? But TCS, being the first of the IT companies, reporting its numbers, it will be a bellwether. It will set the tone for the rest of the IT sector. And in that context, what the street is going to be watching out for, FY24, any indications about revenue or margin pressures for the next year in terms of client budgets, in terms of hiring, deal wins, all that is going to be very crucial. But we'll get more clarity from the management. They will be addressing the press conference at 5:30 p.m. So tune in for that. Back to you.
Hey, thanks a lot for that. In any case, the stock has been under a lot of pressure. It's down almost 19% in 2022. Has been a really rough ride for TCS. But let's do one thing. Let's slip into a quick break. On the other side, our special segment, it's the economy. Lata will connect with Chetan Iyer, the Chief Asia Economist at Morgan Stanley, to discuss the global macro cues. Do stay tuned in for that.
The rupee has touched a fresh low of 82.62 in opening trades. Thereafter, there's been some Reserve Bank intervention, but the rupee's weakness was expected after the US unemployment data for September came in a surprisingly low 3.5%. The estimate was 3.7%. With the US job market likely to remain hot, wages high, the Fed is expected to only continue its tightening spree. There is going to be an impact on all economies, Asia, India. To discuss that impact, we have with us Chetan Iyer, the Chief Asia Economist at Morgan Stanley. Good morning, Chetan. Thank you very much indeed for joining us. Well, I read your report saying that Asia is not that badly impacted. Can you tell us where this confidence comes from?
Well, essentially what we are saying is that, look, this is a very different cycle compared to 1997 or 2013, in the sense that Asia's macro stability indicators are in a much better shape. And Asian governments and central banks have not really taken up loose fiscal or monetary policy to the same extent as they had done. Especially if you think of it in 2013, after 2008, there was an aggressive fiscal and monetary policy easing across the region. And we had seen a big pickup in leverage. We had seen a quick deterioration in macro stability indicators such as inflation or current account deficit. If you take India's specific example, we had current account deficit going up to about over 5% in December 12 quarter. And at the same time, inflation had been running close to 10% for about 4 years at that time. So we don't have that kind of situation in this cycle, and therefore we think that Asia is doing much better. And then the market's verdict, if you look at it, if you look at the trade-weighted exchange rate for the region as a whole, it is down just about 2% in this cycle versus about 13% decline in 2013 and a much sharper decline in 97, 98. So I think the currency performance is also telling you have to look at currency performance on a trade-weighted basis, not just against the USD.
No, I take your point that there are several macros which are I mean, we are not in the fragile five discussion at all like we were in 2013 or, I mean, the Asian crisis of 1997, which was much worse. But let's take only India. There is a current account deficit issue. Even if it is not as bad as above 5%, it is above 3%, whereas our normal Lakshman Rekha is 2.5%. Wouldn't that be a worry, especially if it got compounded with, capital outflows like it was in June, July?
So, look, I think the recent trade deficit and current account deficit numbers have been priced to very high levels of oil prices that we had seen immediately after Russia's invasion into Ukraine. But after that, oil prices have come down, even after the oil production cut announced by OPEC+. Oil prices are still below $100. So if you still see oil prices below $100, we think India should be able to manage a current account deficit, which is in the ballpark of 3%, which is a little bit higher than 2.5% number that as a threshold has been identified by the RBI. But it's not that far off from that manageable level of 2.5%. So we think that it will mean currency depreciation pressures, but it won't be such that it causes a major shift in the central bank's monetary policy in a disruptive manner.
Okay, I was coming to the Indian central bank and the Indian growth story. But before that, a word on what's Morgan Stanley's view of the US rate hikes. Do you expect as much as the dot chart indicated, that is 75 and then a 50 in December and another perhaps 25 in March, or even a 50 in March? Is that the in-house view as well?
Yeah, our forecasts are very similar. So we are expecting the Fed to take policy rates to 3.6 to 5. So call it between the band of 3.5 to 3.75. And in the next meeting, we're expecting 75 basis points, and the meeting after that, 50. And then in January, we're expecting another 25 basis points. So by early next year, Fed would have reached its peak policy rates of 4.6 to 5.
Well, actually, after the jobs data, the CME Fed Watch monitor is indicating slightly higher bets. Of course, the percentages are still low, but people have pushed up bets for more hikes. Now, if it pans out this way, I mean, if it pans out even at 4.5 or 4.75 on the Fed funds rate, won't it have an impact on what the Indian central bank has to do?
So, look, I think in terms of the market's expectations, markets are currently pricing anywhere between 6.5 to 7% for the RBI. And for the Fed, it is pricing around 4.65 to 4.7. And the way the currency pressures will build for the central bank would be on the basis of the expectations of policy rates for the Fed and expectations for the policy rate for the RBI, or whatever the RBI guidance would have been. Now, based on this outcome, we think that incrementally the pressure should reduce as long as the Fed pricing doesn't go up further from here. And as I mentioned, our forecast is for the policy rates to peak around 3.6 to 5. So we are in sync with markets pricing. And we are not expecting further rise in markets expectations for policy rates. If it does happen, then there will be more pressure for the rupee and therefore consequently pressure on the RBI. And on the RBI's policy rate forecast, we are expecting it to take policy rates to 6.5% with some upside risk of maybe another 25 basis points hike. But that's where exactly the market is. So I think we are okay as far as the current market pricing is concerned.
Okay, fair enough. Just as a matter of detail, after the jobs numbers came out and unemployment was even lower than what, even lower than August and lower than market estimates, did you all, is there an upside bias to your estimates? More likely 475 is the terminal rate in US?
No, we haven't changed, Lata. We were building in for a 75 basis point rate hike and the terminal rate at 4.625. And we are maintaining that. Of course, Fed as well as us, we will need to watch the data going forward. And if you get series of upside in unemployment rate or other downside in unemployment rate, that would make us change, and that would probably also make the market change the pricing for the Fed policy path.
Okay.
But with this small little, surprise on the unemployment rate, look, as far as the jobs data is concerned, wage growth actually was well behaved. It was still 0.3% month on month, which is 3.6% annualized, and year on year went down from 5.2 to 5. And jobs print was 268. Versus consensus of 255. So there wasn't a whole lot of upside surprise in the jobs data, except for maybe a tenth or 2/10 of downside in unemployment rate. That's what probably spooked the market. And preceding that, there were hawkish commentary or hawkish statements coming out from the Fed policy speakers, and that in combination made the markets a bit more worried. But as such, if I just take the data on its own, it wasn't really that big a surprise for us to make a change in our forecast.
Okay, fair enough. Time permitting, I'll come back to that, the impact that the tightness in the credit markets can have. But for the moment, the India growth story. Would you worry that the global markets are heading towards a recession or probably near a slowdown? And that can have an impact on exports, that can have an impact on, which can have a multiplier impact on India's domestic growth?
That's right, Lata. So we are expecting, DM GDP growth to be just about 30 basis points in 2023, with US at 50 basis points positive and Europe at 50 basis point contraction. And UK would be about 90 basis point contraction. So DM growth is going to remain extremely weak in 2023. And that will mean that exports outlook is not looking good for the region as well as India. The advantage that India, of course, has is that it has also got significant dependence on services exports. That tends to be a bit more defensive, doesn't see that much of a deceleration like you would see for the goods exports. But then nevertheless, India will still see downside from exports and its consequent impact on some negative impact on the manufacturing capex too. Okay. So we are expecting India's growth to slow to 6.2% in the next financial year. And for the current financial year, we are at 7%. Okay.
Well, just a quick one. Looks like we're running out of time. The tightness in the credit markets, you saw the BOE having to intervene against its promised sale of bonds, it had to come in and buy bonds. There is a lot of tightness even in the US markets with the yields, for instance, on, even on for treasuries, the credit market appears to have tightened. And of course, for the real economy, home loan rates have doubled. Do you think that this tightness in the credit market can create some financial accident?
So look, I think there are risks of financial markets tightening in countries other than the US, a lot more than the US itself. In the US, yes, we have seen tightening in financial conditions, especially for credit markets. But the dynamic that we have for the corporate balance sheets is very different in this cycle. So for example, high yield space, which would be called as the riskiest space within the corporate borrowing segment. That segment has just about 10% of its debt falling in due over the next 2 years. And which means that, bulk of the borrowing has been taken up at low fixed rates before this time. And at the same time, the interest coverage ratios are close to all-time high. So we think that the economy in the US, especially from a balance sheet standpoint, in a very different position. And so that would be able to withstand and not have a significant recessionary risk. All what we are arguing is that this will mean slower growth.
Okay.
But we're not concerned about a deeper recession this time because of tightening of financial conditions.
No, I read a goodish bit of worries about the credit market just becoming dysfunctional and that creating problems. But that discussion for another day. Chetan, just leave me with the last number. How bad does it get for the rupee? Do we cross 83?
Well, I don't make the rupee forecast, but yeah, I would say that, it's completely dependent on the dollar.
Okay.
We think that the idiosyncratic pressures on the rupee are much lesser in this cycle.
Okay.
It's more really a function of what happens to DXY, and it's just a broad trade-weighted dollar that's what is going to weigh on the rupee.
All right, we'll leave it at that. Thank you very much, Chetan here, for joining us. We wrap up with the stock market still under pressure, 1.2% gone, but we could see some recovery after all the US is not trading today. Wrap up on Bazaar. Chartbusters up next.